All right, welcome back to another episode of the BG Trading Bootcamp. Today we're going over liquidity, what it is, why it is important, and how to take advantage of it. And then in the second part of this video, we're going to be going over liquidity sweeps, what it is, how to use it, how to spot it, how to use it in your trades, and how to take entries because the strategy that we use involves liquidity sweeps, and you're going to have to know what it is, how liquidity works. As I said, liquidity is the number one most important thing in the markets, and the reason being is because of what it is. So what is liquidity? It literally just means how much orders are resting in a certain place. So high level of liquidity, that means there's a high level of orders. That's all it means. When people say liquidity, it just means orders. Is there orders there or is there no orders there? So for example, an inefficiency, which is a fair value gap, has no orders. So there's no liquidity there, which is why sometimes price comes back to fill that in, to fill in orders that were placed, the price never reached to. So what is liquidity? Once again, just where a high amount of orders are resting. So for example, that is why swing highs or high levels of liquidity, because for example, you just have to think of it psychology wise. If you're looking to take a trade, where would you put your take profit or stop loss? Would you put it at a random high like here, or down here, or here? Or would you put it at prominent highs like here, or here, or here? So liquidity is just where the most people put their stop or limit orders or market orders, not market orders, but whatever people put their most limit orders or stop orders, that is where liquidity lies. So that's why sometimes you see liquidity sweeps to go and take out those certain spots and then go in reverse another way. So what is liquidity? Once again, it's just how many orders are lying in a certain spot. Why is it important? Is because that is the whole reason the market moves. So you need to understand what liquidity is, where it lies, and the reason why it's important is because that's why it moves. If there was no liquidity, the whole market would not exist. So how do you take advantage of it? You find your buys for the day, and then you find what are the closest liquidity spots that make sense to take out. And that's where you base every single trade off of. And that's how most people go from unprofitable to profitable, is by targeting liquidity, by thinking where do other people have their stop orders, where does market want to go. So that brings me to liquidity sweep. First, I'll talk about actually why why where liquidity really lies. So as I said, it does lie at these high swing lows and swing highs, but another place that it lies is session highs and session lows. So as a matter of fact, I'll mark out some of the most high spots of liquidity. So the number one spot for liquidity is going to be new week opening gaps. And then it's going to be swing highs. And lows. And then it's going to be unfilled for value gaps. And lastly, it's going to be session highs and session lows. I know this is still the basics, but I'm just giving you a brief overview of where the most liquidity lies in the market. So these are pretty much places where we have a video later on going over where to put your TP and stop loss, and it goes over all of these. But for now, I'm just giving you a brief overview that this is where most liquidity lies in the market and where prices want to go to every single day. If you look at any single time frame, any single session, price either goes into a new week opening gap, takes out swing highs or lows, goes into unfilled gaps, or takes out session highs and lows. So what is a liquidity sweep? A liquidity sweep is literally when there's a leg up or down to take out these resting orders. So for example, we had resting orders right here. This was a swing high. We had a lot of orders sitting here. What do we see? We saw price want to come up, take out and fill in some of these orders that were resting here, which is a high level of liquidity, and then we proceeded to go down. So how could that help? Let's say you were trading right here and you knew that this was a high level of liquidity because let's say it was a session high and it was a swing high. Then when you're right here, all you need to do is look for an entry at this spot. So you could take it and then target this right here as your TP, which is a high level of liquidity, meaning price wants to go up there and acts as a magnet. So once again, that could help with context, that could help with your discretion. So how do you use it? As I said, once again, you could either use it for your TP when you're entering a trade, or you can use it. There's actually multiple ways. The number two way to use it is, let's say that you're in a trade. So let's say you enter right here, and then this is your TP. Let's say this is right here is another level of liquidity because it's another prominent high. When price reaches this high, it could be a good spot to go break even because we've taken out a high level of liquidity and we could potentially reverse how we did up here. Or another way to use it is to officially spot the start of a reversal. So as we saw here, we took out this liquidity, and at that point, you can obviously start looking for shorts if that's where your bias was for the day, because we took out a high level of liquidity and then we proceeded to go lower. So once we took out this liquidity, you could have started to look for shorts anywhere over here. So I'm going to show you just a couple of examples of liquidity sweeps in the markets. I mean, you can see it over and over again. Here, here, here. We came up, we swept these highs, and we went lower. Up, swept these highs, and we went lower. Came up, we swept these highs, and we came down lower. And the opposite is for the bottom side. Here, right here. We came down, we swept these highs, we went higher. And then right here, we came down, we swept these highs, left the wick, went higher. Same thing here. We came down, swept these lows, went higher. Doesn't matter what time frame you're on. You go on the daily, you even see it here. We came down just to sweep these highs, and as soon as we swept them, we came lower. So you can see patterns do exist. You just got to be, aware of where they are. What do we do here? We came up, swept this, went lower, filled in gap, went higher. That's all it is. Right here as well. Came up, swept this, lower. This is on a daily, so it's not going to be as easy to find examples, but you could find this once again on any time frame. We already went over these examples. So yeah, once again, in a trade, you could be targeting these spots. Pretty much liquidity serves as a magnet of where price is going to go. So you could once again target as liquidity, target it once it hits it as your place to go break even, or target it as an example of a reversal. So if you are bearish on a day, but we're having bullish market structure, as soon as we take out the liquidity, you can start being bearish and look for those shorts.